Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good. I'm ready to get into it.
So I want you to imagine turning on the local news, right? And you see that a massive historic winter storm is about to hit your town.
Oh, man.
Yeah, and the power grid is basically guaranteed to fail. So you rush down to the hardware store to buy a backup generator, like just a standard model that usually goes for about $1,000.
Right. The essential survival gear.
Exactly. But when you get there, the owner is charging $5,000 for the exact one sitting on the floor.
Whoa.
Right. But he tells you, hey, you can pre-order this exact same generator for delivery next month for the normal $1,000 price.
But the storm is tonight.
Exactly. Today, right now, with those storm clouds gathering, the cost of holding that physical machine in your hands is completely divorced from its normal value. You are paying pure surge pricing, just for immediate survival.
Yeah, that's what we call the panic premium. You're paying for the physical reality of having power tonight rather than, well, a financial promise of power next month.
And that dynamic, that exact panic, is playing out on a massive global scale as we look at the oil markets right now in late April 2026.
It really is. It's wild.
We are looking at a system that has basically developed a massive split personality. There isn't just one single price of oil flashing on a ticker tape anymore.
No, not at all.
We are seeing a historic gap between the price to get a barrel of oil physically delivered today versus the price to secure a barrel for next month.
Which is incredibly rare to see at this scale.
Right. And our goal with this deep dive is to figure out the actual mechanics behind that gap. Because according to recent analysis and data from Reuters and the U.S. Energy Information Administration, the EIA, this isn't just a simple story of the world running out of oil.
Exactly. It's not a supply shortage in the traditional sense.
Right. It's a massive global logistics bottleneck.
Yeah.
So we need to break down how a beginner American investor can navigate this, without getting burned by misleading headlines.
Yeah, because understanding the underlying structure of a commodity market is far more critical than just tracking its daily price movements. I mean, if you only look at the top-line numbers being reported on the evening news, you're missing the actual mechanics of how energy physically moves around the planet.
Totally. So let's start with those numbers, because earlier this month, the data was just absolute wild. Seasoned traders were doing a double take.
Oh, yeah. The sheer scale of the divergence is what really stands out here. So in early April, physical crude prices, and by that I mean what an industrial buyer pays for a barrel of oil delivered to them immediately, which is known as the spot price. It neared $150 a barrel.
Wow.
Yeah. Specifically, a major global benchmark known as dated Brent hit the $144 range. But meanwhile, futures contracts stayed significantly lower.
And just to make sure we're entirely clear on the vocabulary for everyone listening, a futures contract is essentially a binding financial promise, right?
Correct.
An investor or a company is locking in a price today for a barrel that will arrive in, say, 30 or 60 days.
Exactly. That is the entire function of the futures market. It allows companies to hedge their costs. But looking at the EIA data, at one point in early April, the spot price for dated Brent carried a staggering premium of over $25 per barrel compared to those near-month futures.
That's huge.
It is. And to bring us up to the current moment, by April 24th, Brent futures actually closed at $105.33.
Okay, wait. A $25 gap between today and next month seems enormous. Usually, aren't we talking about a difference of like a few cents or maybe $1 to account for the cost of storing the oil?
Yes, exactly. A $25 premium indicates that something within the global delivery system is deeply, deeply stressed.
So people are panicking.
Completely. Physical buyers, and here we're talking about massive industrial refineries and chemical plants, were financially backed into a corner. They needed the physical crude immediately to keep their multi-billion-dollar facilities running, and they were basically willing to pay whatever the market demanded.
Which brings us to the core mystery of this deep dive. Because if you look at the domestic energy landscape right here in the United States, production is strong.
Very strong.
There is plenty of oil in the world. So why are these global buyers paying surge pricing for the generator? What is causing the immediate panic?
Well, the narrative has to shift from a simple supply and demand equation to a complex logistics and delivery crisis. The globe is not entirely out of oil. The bottleneck is the physical delivery mechanism specifically focused on the Asian market right now.
Okay, so what's happening in Asia?
Well, according to Reuters data, Asian crude imports plummeted by 22% year over year. They dropped down to 20.4 million barrels per day.
Wait, a 22% drop for an entire continent? That is like the equivalent of the global manufacturing floor suddenly having its raw materials slashed by a fifth.
Exactly. It's the lowest import level we've seen in a decade, easily going back to 2016.
Oh, wow.
And the knock-on effect is immediate. Because of this lack of incoming physical crude, Asian refinery operations are expected to drop steadily through May. The ships simply aren't arriving at the docks with enough raw material to keep the refining machines running at full capacity.
See, here's where I start to get a little confused.
Yeah.
Because if Asia is desperate for oil and, the Middle East is having trouble putting oil on ships and the U.S. has abundant oil just sitting in domestic storage, why not just establish a new supply line?
It seems logical, right?
All right. Can't the U.S. just load up tankers, send them across the Pacific, and plug the hole in the Asian market?
Well, the assumption there is that all oil is chemically identical, which is actually a really common misconception. Oil is absolutely not just oil.
It's not.
No, it comes out of the ground in vastly different grades and chemical compositions. And this brings us to the refinery dilemma, which is the hidden crisis driving these bizarre market numbers.
Okay, break it down for me.
So Asian refiners have spent decades and invested billions of capital calibrating their massive processing facilities to handle heavy, sour crude oil, which happens to be the primary export of the Middle East.
Why build a refinery for a specific type of oil, though?
Because heavy crude is the ideal chemical starting point for producing middle distillates. In plain English, that means diesel and jet fuel.
Ah, got it.
Yeah, and those Asian economies, they run on diesel for their trucking and shipping and jet fuel for their massive aviation sectors.
So because the heavy crude from the Middle East is trapped behind these maritime bottlenecks, these Asian refiners are being forced to substitute their normal raw materials.
Exactly.
They're having to buy light, sweet crude, primarily from the United States, the benchmark known as WTI or West Texas Intermediate, and also from West Africa.
Right. And that substitution creates a massive industrial inefficiency.
It makes me think of like a massive industrial bakery that holds contracts to deliver thousands of dense, heavy chocolate cakes every single day to local grocery stores.
Oh, I like this analogy.
Right, so their commercial mixers, their oven temperatures, their baking times, every piece of machinery is perfectly calibrated for a very specific heavy baking flour. But suddenly their supply chain breaks down, and the only thing the bakery can get their hands on is light, airy pastry flour.
Yep. And the bakery obviously doesn't want to shut down its ovens entirely, so they attempt to bake with what they have.
They keep the machines running, but the yield is completely wrong. They can't produce the dense chocolate cakes their customers actually contracted for.
Yeah.
They end up with massive batches of, light angel food cake.
Exactly. And in the refinery world, the U.S. light crude is that light pastry flour.
Okay, that makes so much sense.
Yeah, so when Asian refiners run light American crude through systems built for heavy Middle Eastern crude, the chemical yields change dramatically. They simply cannot produce the necessary volume of diesel and jet fuel. They end up producing more gasoline and lighter chemical byproducts instead.
So we are looking at a cascading failure.
Completely. You have a primary shortage of crude oil arriving at the docks, which then generates a secondary structural shortage of diesel and jet fuel coming out of the refineries.
And that panic is incredibly localized to specific industries then. That secondary shortage really explains why the international benchmark, Brent, and the U.S. benchmark, WTI, are behaving so differently right now.
Spot on. The EIA projections really highlight this geographical divide. They projected the Brent WTI price gap to hit $15 in April.
Wow.
Because U.S. WTI oil is relatively insulated from the global storm. It's sitting in domestic storage tanks in places like Cushing, Oklahoma, and moving through domestic pipelines. It is physically far away from international maritime choke points.
Right. WTI is the generator sitting safely in the pantry.
Exactly. Brent, on the other hand, is the benchmark tied to ocean delivery risk, maritime insurance spikes, and shipping delays. It is the barrel of oil out on the water. So WTI spot prices didn't spike nearly as violently as Brent.
Interesting.
Now, the EIA notes that if the global maritime choke points, specifically the Strait of Hormuz, fully reopen and normal traffic resumes, this gap is expected to narrow significantly, down to about $9 in the third quarter and $4 in the fourth quarter.
Okay, let's talk about the Strait of Hormuz for a second, because this is where geopolitics really collides with the physical market.
Yeah.
For anyone who isn't staring at a map right now, The Strait of Hormuz is a narrow stretch of water between the Persian Gulf and the Gulf of Oman.
Right, a very tiny, very critical waterway.
Exactly. It's a 21-mile-wide choke point, and a massive percentage of the world's total oil supply has to physically float through it. And if you turn on the news right now, the headlines are completely dominated by diplomacy regarding this exact waterway.
They are.
So how is Wall Street reacting to the political headlines versus the actual reality of giant metal ships sitting on the water?
Well, the divergence between the financial futures market and the physical spot market is incredibly stark. Looking at the timeline, on April 20th, President Trump announced an extension of the ceasefire deadline with Iran,
Right.
and the reaction on the trading floor was instantaneous. Brent futures briefly crossed $101 before relaxing and falling back down to the $99 range.
I mean, if I'm a trader sitting in Manhattan, I see a headline pop up on my terminal, ceasefire extended, my algorithms kick in, and I sell off some futures contracts because the geopolitical risk just dropped. Wall Street is betting heavily on a diplomatic fix.
Exactly. They are assuming the politicians will sign a paper and the supply chain will magically fix itself.
But that's not how it works in the real world.
No, because the financial market trades on anticipation.
Hmm.
But the physical buyers, like the logistics managers who actually have to source heavy crude to keep chemical plants from shutting down, they are pushing back hard on that optimism.
Right.
According to recent reports, on April 25th, French President Macron had to publicly reaffirm efforts to reopen the Strait of Hormuz, which indicates the situation is far from resolved. Additionally, the CEO of Total Energies explicitly warned that prolonged disruptions could severely deepen Asia's energy shortage.
So we basically have two completely different realities operating parallel to each other. The financial markets trade at the speed of light based on press conferences and political optimism. But the physical markets trade on cold, hard reality.
Exactly.
The logistics manager doesn't care about a ceasefire extension. They care about whether maritime insurance premiums for their tankers have dropped to affordable levels and whether the heavy crude has actually arrived at the port in Singapore.
Because a ceasefire document is just a piece of paper, it does not instantly teleport millions of barrels of heavy crude across the ocean. Until the physical reality of shipping changes, the spot price is going to stay heavily elevated. The physical market is demanding tangible proof of delivery, not political assurances.
Okay, so we have laid out the macro economy. We have surge pricing for generators, a bakery producing the wrong kind of cake, and a massive disconnect between Wall Street algorithms and physical cargo ships.
That's a good summary.
Let's bring this down to the individual level now. How does a beginner American investor apply this knowledge to their own portfolio? Because reading these dramatic headlines about $150 oil might tempt someone to jump into the market, but from what you're saying, it sounds incredibly dangerous.
It is. The biggest trap for retail investors in this specific environment involves energy exchange traded funds, or ETFs.
Okay, how so?
Well, when the spot price, the price to get oil today, is massively higher than the futures price, the price next month, the market is in a structural state known as backwardation.
Let's define backwardation carefully, because this is where the financial plumbing gets a bit weird.
Yeah, it does.
If I open my brokerage app, I buy a standard oil ETF, and the news says physical oil hits $150. My instinct is that my ETF is going to shoot up to match that $150 price tag.
And that instinct will cost an investor money. Why? Because ordinary energy ETFs generally do not buy physical barrels of oil and store them in a warehouse. They buy financial futures contracts. And because those futures contracts eventually expire, the fund managers constantly have to sell the contract that is about to expire and buy the next one further out in time to maintain their position.
Right, right.
This mechanical process is called rolling the contracts.
Wait, I've heard about this. If the ETF is constantly rolling contracts, aren't they losing money every single month just to maintain the fund?
You are thinking of the opposite market condition, which is known as contango. That's where future prices are higher than current prices.
Oh, okay.
Yeah, in contango, selling cheap expiring contracts to buy expensive future ones creates a structural drag on the ETF. But backwardation is different. In a backwardated market, the ETF is selling the more expensive expiring contract and buying a cheaper future contract, which actually generates a positive roll yield.
Oh, interesting. So backwardation isn't bleeding the ETF dry.
Right, exactly. The trap in a backwardated market isn't a mechanical loss of value. It is a massive expectation mismatch and opportunity cost.
Explain that expectation mismatch.
The ETF is anchored to the futures curve. They own the contract priced at, say, $105, not the physical barrel priced at $144. So when the retail investor sees the $150 headline spot price and expects their ETF to jump 40% overnight, they are deeply disappointed.
Because it just doesn't work like that.
No, the fund simply does not capture the immediate panic premium playing out in the physical market.
So you are basically buying the delayed, optimistic reality of the futures market, not the current, frantic panic of the spot market.
Precisely.
If an investor blindly buys a Standard Oil ETF based on a dramatic news headline, the underlying mechanics of the fund might completely disconnect them from the very price action they were trying to capture.
That's exactly it. Relying on the absolute price level is insufficient. An investor has to understand the shape and structure of the market. And based on the structural analysis, the broader market can be divided into clear winners and losers.
Let's run through those. Who actually benefits from this specific, bizarre setup?
The beneficiaries are the entities that have immediate physical access to the market. So upstream producers who are actively pulling oil out of the ground today and selling it at spot prices.
That makes sense.
Also, oil storage and trading companies, the firms that physically hold tanks of crude and can sell it at today's extreme premium. And, of course, the entire North American light crude export chain.
Wait, even though the American light crude is the pastry flour that Asian refiners don't really want.
Yep.
Those refiners are still buying it out of pure desperation just to keep their facilities running, right? So U.S. exporters are seeing massive volume.
Exactly. The export terminals are running at maximum capacity. But on the flip side, the entities absorbing the pain of this physical shortage are widespread. Asian refiners are seeing their profit margins completely crushed by the chemical inefficiencies of running light crude.
Because they're baking the wrong cakes.
Exactly. Also, chemical companies that rely on specific petroleum byproducts as raw materials are facing severe supply constraints. And heavily exposed in all of this are the global airlines.
Okay, let's think about the airline stocks for a second, because that feels like a massive trap for a beginner.
It really is.
Someone sees President Trump announce the ceasefire extension, the stock market rallies on the news, and the investor thinks geopolitical crisis averted, airlines are going to bounce back immediately, I should buy now. But if I'm holding an airline stock, I should actually be terrified right now, shouldn't I? Because they are the ones paying this massive spot premium for fuel.
You're exactly right. The stock market might eagerly try to price in a future recovery based on diplomacy, but the physical airline still has to fuel up its fleet today.
They still have to fly the planes.
Right, and they're being squeezed by that secondary shortage of jet fuel we discussed earlier. The agonizingly high cost burden is immediate, and it hits their balance sheet this quarter, while the diplomatic solution might take months to physically manifest as cheaper fuel at the airport.
The ceasefire extension doesn't lower their fuel bill for the flights taking off tomorrow morning.
It definitely doesn't.
And I imagine this pain extends beyond just corporate balance sheets to entire countries, right?
Oh, absolutely. The currencies and sovereign bonds of nations that are heavy net importers of energy are taking a massive hit right now. These countries have to spend significantly more of their national wealth, often depleting their foreign currency reserves just to keep their power grids online and their domestic logistics networks functioning.
Wow. We started with a headline about oil prices and ended up dismantling global shipping logistics, refinery chemistry, and the hidden mechanics of ETFs. It really shows how interconnected the whole system is.
It's all tied together.
So, if we distill all of this down, what is the core framework an investor should walk away with today?
The fundamental lesson here is that an investor must look past the daily direction of commodity prices and analyze the underlying structure of the market. You have to distinguish between the daily political noise, the press conferences, the diplomatic statements, and the actual physical fundamentals.
Like, are the ships actually moving?
Exactly. Are the shipping volumes out of the Middle East actually returning to normal? What do the Asian refinery yield reports look like? You have to understand the profound difference between the fast-moving, anticipatory financial markets and the slow, heavy, logistical reality of the physical world.
Right.
Separating the noise from the fundamentals really is the only way to navigate these bifurcated market structures.
That is fantastic advice. And before we wrap up, I want to leave you, the listener, with a final thought to mull over. We've spent this deep dive talking about maritime choke points, Asian jet fuel shortages, and refinery yields. It all sounds very macroeconomic and perhaps a bit removed from the average American portfolio. But consider how this massive physical bottleneck eventually forces its way into the broader domestic economy. Because if global shipping conglomerates and international supply chains are paying absolute top dollar for fuel today just to keep cargo moving across the ocean, well, that surge pricing doesn't just disappear.
No, it gets passed on.
Exactly. It gets baked into the cost of goods. So if those massive fuel premiums hit the global supply chain, how long will it take for that cost to show up in the consumer price index data here at home?
That's the real question.
Right. And if inflation metrics begin to spike again because of a logistics bottleneck halfway around the world, what does that mean for the Federal Reserve's next move on interest rates?
Mm.
Because regardless of what the stock market does tomorrow or what a politician says on television, those physical costs ripple outward.
They absolutely do.
It's definitely something to think about the next time you are rebalancing your portfolio and trying to anticipate the broader economic weather. Don't forget to subscribe and hit that like button.